Imagine keeping your money in a regular savings account where it barely grows and inflation slowly erodes its value. Now think about putting that same $10,000 to work, earning income every quarter and growing alongside some of the most dependable companies in the US. That's exactly what dividend ETFs are offering in 2025. These funds provide diversification, steady cash flow, and long-term growth, all in one package. In a year marked by inflation, market volatility, and global uncertainty, dividend ETFs have quietly outperformed many traditional investments. Today, let's explore what happens when $10,000 is invested in the top 3 dividend ETFs of 2025, plus a bonus tip to boost your gains. Let's get started by looking at one of the most talked about ETFs in the dividend world, Schwab US Dividend Equity, ETFs SCHD. First up, SCHD. This is the Schwab US Dividend Equity ETF, and it's earned its spot as a favorite among dividend investors. The fund tracks the Dow Jones US Dividend 100 Index, which means it focuses on around 100 large-cap US companies that have a strong record of paying dividends. Right now, SCHD is offering a dividend yield of about 3.7%. That's more than double what the S&P 500 is offering, which already puts this ETF ahead of the pack. Even better, its expense ratio is just 0.06%. So only $6 out of a $10,000 investment goes toward management costs for the entire year. That's a great deal considering what you're getting in return. Its top holdings include well-known names like Coca-Cola, Verizon, and ConocoPhillips, companies that have solid balance sheets, good cash flow, and reliable dividend histories. SCHD screens for businesses with at least 10 consecutive years of dividend payments and strong financial metrics, so the quality bar is set pretty high. Putting $10,000 into SCHD with that 3.7% yield would mean earning around $370 each year in dividends. These payouts are distributed quarterly, so there's a nice rhythm to the income. If those dividends are reinvested, the power of compounding kicks in. Looking at historical returns, SCHD has averaged around 10% to 12% annually when price appreciation and dividend reinvestment are factored in. So with a 10% annual return, that $10,000 could grow to about $25,937 after 10 years. What's even more encouraging is how SCHD is performing in 2025. So far, it's up 8.5% for the year, even as the broader market is down about 4.17%. That makes this fund especially attractive for anyone trying to balance steady income with reliable growth in a shaky market. Another standout feature of SCHD is its focus on companies with strong return on equity, which often signals efficient use of investor capital. This metric helps the fund zero in on businesses that are not just profitable, but also well managed. It also avoids real estate investment trusts, REITs, which helps reduce exposure to interest rate-sensitive sectors. The ETF has a relatively low turnover rate, which means fewer taxable events for shareholders, another plus for long-term investors. Many consider SCHD a core holding in a dividend-focused portfolio because of its blend of quality, income, and capital appreciation. It's also gained a loyal following due to its transparency and consistency, with clear selection criteria that don't shift wildly year to year. For investors looking for a reliable way to tap into U.S. economic growth while collecting dividends, SCHD checks all the right boxes. Vanguard High Dividend Yield ETF, VYM. Next on the list is VYM, the Vanguard High Dividend Yield ETF. This one takes a broader approach by spreading investments across nearly 590 U.S. stocks. That wide net can really help reduce the risks tied to any single sector or company. VYM is currently offering a 2.8% dividend yield. While it's a bit lower than SCHD's, it's still respectable, and it comes with the same ultra-low 0.06% expense ratio. That makes it one of the most cost-effective dividend funds available right now. The sectors it leans into most are financials, which make up about 20.4% of the fund, followed by healthcare at 14.3% and industrials at 13.2%. Some familiar names lead the holdings here, including JP Morgan Chase, ExxonMobil, and Johnson & Johnson. These are time-tested companies that have paid dividends through thick and thin. The wide diversification of VYM also makes it great for those who want exposure to a variety of industries without micromanaging their portfolio. So, investing $10,000 in VYM at the current yield would produce about $280 in dividends per year. That's a little less than SCHD, but the trade-off is a broader safety net. Assuming a 9% average annual return, that investment could grow to around $23,673 over a 10-year period if dividends are reinvested. This year, VYM has returned about 6.2% year-to-date, which is solid considering the broader market's negative performance. With over $54 billion in assets under management, VYM is also one of the most trusted and widely held dividend ETFs in the game. It's a strong choice for those who want a dependable, hands-off way to build wealth while enjoying some income along the way. In addition to its performance and low cost, VYM also benefits from Vanguard's strong reputation for investor-first principles and long-term stability. The ETF's massive asset base helps it maintain high liquidity, meaning shares can be bought or sold easily without wide price swings. It's also rebalanced quarterly, which keeps the fund aligned with its goal of capturing high dividend-paying companies across the market. Another reason investors like VYM is its low turnover rate, helping minimize unnecessary trading and capital gains taxes. For those who prefer simplicity, VYM is easy to hold long-term without constantly needing to monitor or adjust. It's the kind of fund that fits well into a buy-and-hold strategy, especially when building a retirement portfolio or supplementing other income-generating investments. First Trust Morningstar Dividend Leaders, FDL. Now for a slightly different angle, FDL. This is the First Trust Morningstar Dividend Leaders Index Fund, and it's geared more toward investors looking to maximize income. FDL stands out for offering one of the highest yields among large-cap dividend ETFs, sitting at 4.5% as of this year. For a $10,000 investment, that means about $450 in annual dividends. That level of income is particularly appealing for retirees or anyone looking to generate more immediate cash flow. It does come with a slightly higher expense ratio of 0.45%, but for those chasing high, sustainable yields, the cost may be well worth it. FDL tracks about 95 U.S. companies with a strong history of consistent and sustainable dividend payments. The fund focuses heavily on sectors like healthcare, financials, consumer staples, and energy. Leading the way in its holdings are companies like Verizon, Chevron, and Altria Group, businesses known for their reliable, generous payouts. Over the long term, FDL has delivered average annual returns of around 8%. It's a bit lower than SCHD or VYM, but with dividends reinvested, a $10,000 investment can still grow to about $21,589 over 10 years. Of that, roughly $4,500 would come just from dividend payments alone. In 2025, FDL is proving its strength, already returning 8.8% year-to-date. That's especially notable in a market where high-yield stocks often get punished. What makes FDL even more attractive is that it doesn't just chase the highest-paying stocks. It emphasizes sustainability, meaning it targets companies that are likely to maintain those yields over time. The portfolio tends to lean into sectors that do well during downturns, offering a bit of defensive cushion. On top of that, FDL rebalances quarterly, so it stays aligned with its dividend-focused mission. For anyone looking to keep things simple while earning high passive income, FDL definitely earns its place in the conversation. Comparing SCHD, VYM, and FDL in 2025. Lining these three ETFs up next to each other, the differences and strengths become pretty clear. SCHD offers the best combination of income and long-term growth. It delivers a healthy 3.7% yield, charges next to nothing in fees, and sticks to a concentrated list of high-quality names. That makes it great for investors who want consistent returns and a solid chance at compounding wealth over time. VYM offers more diversification than SCHD, with 590 stocks under its belt and exposure across multiple sectors. The 2.8% yield is still respectable, and the ultra-low fees are a big plus. For anyone who values stability and prefers a wider market footprint, VYM is a very attractive option. FDL takes the crown for highest yield, sitting at 4.5%. It may not have the same growth potential as SCHD or VYM, but the strong cash flow makes it ideal for those who need income now. And thanks to its focus on sustainable dividends, it doesn't take on as much risk as other high-yield alternatives. Looking at potential 10-year outcomes, SCHD could grow a $10,000 investment to about $25,937, VYM to around $23,673, and FDL to roughly $21,589, assuming historical performance trends continue and dividends are reinvested. All three funds have outperformed the broader market in 2025, which is a strong signal of their resilience and reliability. For anyone weighing the options, SCHD makes sense for those aiming for growth with income. VYM is perfect for broader market exposure and long-term balance. And FDL is a go-to if maximizing cash flow is the priority. But combining all three might be the best strategy, creating a balanced portfolio that blends yield, growth, and diversification. Now here's the part that could take these returns to the next level: dividend reinvestment. A lot of investors take their dividend payouts as cash, but automatically reinvesting those dividends into more shares can compound gains in a big way over time. Take SCHD's $370 in annual dividends, for example. Reinvesting that money back into more shares means owning a slightly bigger piece of the fund each time dividends are paid. The next round of dividends then pays out more, and the snowball keeps rolling. This effect becomes even more powerful during market dips, when those reinvested dividends buy more shares at lower prices. Most brokerages allow dividend reinvestment at no extra cost, which makes it an easy decision. And when these ETFs are held inside a tax-advantaged account like an IRA, it also helps shield dividends from immediate taxation, leaving more money in the account to keep growing. For those serious about building wealth, setting up a DRIP could be one of the most effective moves to make. Putting $10,000 into ETFs like SCHD, VYM, or FDL in 2025 isn't just smart, it's strategic. These funds offer a mix of steady income, long-term growth, and the kind of market resilience that's hard to find. Whether the goal is to grow a nest egg, generate passive income, or just have peace of mind in a volatile year, these ETFs check all the boxes. And when dividends are reinvested, the compounding power turns good returns into something even more impressive. This is how consistent, patient investing leads to real financial progress. If this deep dive gave more clarity on where $10,000 could grow best in 2025, don't forget to subscribe to Trades Savvy Academy for more sharp investing insights. Hit that like button, turn on the bell for notifications, and drop a comment below. What's your pick? SCHD, VYM, or FDL? For live stock market updates and alerts, follow on X and stay on top of your game daily. Thanks for watching, and stay savvy.